All right, welcome, Jeff.
Yes.
Jeff, I want to start with a biography of you so that everyone knows who you are and what you're doing. Jeff Olin, co-founder, CEO, and portfolio manager at Vision Capital, a Toronto-based real estate investment firm with an outstanding track record of delivering value through disciplined investing in publicly traded real estate securities. You've been at this for more than 3 decades, experience spanning investment banking and senior executive roles in the real estate sector. And you bring an interesting dual perspective on both the financial and operational sides of the industry. Prior to Vision Capital, of course, in 2008, you held senior roles at leading firms including Desjardins, HSBC, and Canaccord. And under your leadership, Vision's Opportunity Fund has achieved some exceptional long-term returns, far outpacing industry benchmarks, focusing on, of course, deep value, strong fundamentals, and macro-aware positioning. You're also a frequent voice on BNN Bloomberg and in the Canadian investment community, known for calling out both opportunities and risks. And you hold, of course, a Bachelor of Commerce from the University of Toronto and an MBA from the Kellogg Graduate School of Management at Northwestern. So, Jeff, welcome to the show.
Thank you for having me, and pleasure to chat with you and indirectly through to your clients.
Yeah, I appreciate it. Let's talk a little bit about your background, having been in this real estate and investment banking world throughout your career. How has that dual lens shaped your approach to public real estate investing?
Well, we take a private real estate approach, but we do it in public markets. And so it's quite I think in that sense, a unique experience, strategy that we bring to looking at this. We take advantages of some of the inefficiencies that perhaps we can chat on through this discussion. And our mantra is we seek to buy real estate cheaper in the stock market than one can in the property market. And the fact that we bring a direct property lens to this, I mean, we don't, for example, make investment decisions sitting in our office in Toronto. We want to tour the real estate. We want to understand the supply and demand fundamentals of the property types and geographic regions within which we can invest. And we call supply and demand our blood. Some of the cliches you hear in real estate are nonsense. Supply and demand is the key. Interest rates are important. They're always exceeded in importance by supply and demand. Location, ridiculous, frankly. You can have the best located office building in downtown Calgary or San Francisco. How's that going for you? So it's that combination of direct property understanding and inefficiencies that give rise to the opportunity to buy real estate cheaper. And of course, the other key difference is we're a long short fund. So if the fundamentals are negative or valuations are just too high, you can't do anything about that in the property market, and we can do something about it by taking advantage of overvalued situations by shorting.
Okay, so broadly defining real estate as an asset class, can you talk about some of the different vehicles that investors may utilize to actually gain exposure? And I must say, I appreciate you bringing this slide deck because it's fantastic from an educational standpoint.
You're welcome. So yeah, I mean, you can be direct owners of real estate or indirect owners of real estate. You can be private owners or be involved in privately held or publicly traded securities. And there are quite a number of differences amongst them. So, for those that can see the video portion of this discussion, we have a matrix here of a lot of different ways that you can be invested in real estate, from owning the property yourself to being in a private equity real estate fund, to being in a private non-listed, non-traded REIT, to owning a REIT, to having an ETF of a REIT index, to having a mutual fund, or what we do in alternatives. And there are quite a number of differences. I'm not going to run through this whole matrix, but if you're the big difference in property management, if you own that real estate, you better be hands-on. All the other approaches, you don't have to be as hands-on. You don't have to worry about, the heater going off in the middle of the night. What's your initial investment versus follow-on investments? Well, if you own that real estate and you got a capital expenditure, you're paying for it. Where if you're a more passive vehicle, a REIT or an alternative fund, you're not. Even in some of the private REITs, you might think you don't have exposure to CapEx, but effectively you're funding that through some of the returns you're getting. Valuations, if you're in public markets, that's real time. If you're in a private REIT, it's lagging, and we might talk about that. Liquidity is obviously a big difference. If you're in a REIT or an alternative fund or a mutual fund or an ETF, you get a lot of liquidity. If you own that real estate yourself, or you're in a private equity fund that has a 5 to 7 year term, you don't have liquidity. Vacation. You own one property, you own that property. You own two properties, you own those two properties. Where if you're seeking diversification, you need to have multiple REITs, or you want to be in either a mutual fund or an ETF or an alternative. In declining markets, to my knowledge, an alternative fund is the only way to get exposure to declining markets as described by being able to be short. So there's lots of different ways. Time is another factor. You better be hands-on if you're going to own that real estate. If you're in a private equity fund, you're locked up for 5 to 7 years, so it doesn't require a lot of your time. Not much you can do about it over that period of time.
Yeah, REITs are really interesting because what we're seeing from particularly the boomer cohort and I'm seeing this on the retail investor side, are folks that have never invested in publicly traded securities, but they have 5 to 10, maybe more, but realistically the number that we see is 5 to 10 rental doors. They're cashing them all out, selling them in some cases to a corporation, in other cases just other landlords, and going, okay, I just didn't want to be a landlord anymore. I don't want to have the property management side of this in my life, but I still need cash flow. What do I do now? And I only understand real estate, so I don't really want to go buy like Visa stock or something like that. So can you talk a little bit more about how REITs differ from just your average run-of-the-mill stock?
Sure. So, what is a REIT? So REIT is a stock. So think about it of any stock, IBM or, what have you, Bank of Montreal. REITs were created to allow individual investors to participate in a diversified way in owning real estate, but get some of the same tax advantages that direct property owners have. So the big one, of course, is depreciation. And REITs are a flow-through vehicle. There's no tax within the REIT subject to certain conditions that I'll mention. So if you satisfy those conditions, there's no tax within the REIT, and the same tax advantages, the depreciation, gets flow through to investors. So in order to qualify to be a REIT, you got to have at least 75% of your assets in real estate, derive at least 75% of the income from rental income or interest from mortgages or sale of properties, and pay out 90% of the taxable income to dividends. So REITs have distributions that are paid to unitholders. In the United States, they're called dividends. In Canada, they're structured as trusts, so they're called distributions. But that taxable income is different than the distributable income because of that, and the difference is largely depreciation, is that the investors benefit from that flow through, which is a deduction to get taxable income, but is not a deduction from the distributable income that investors get. So it's a tax effective way for individual investors to get exposure to real estate and have liquidity and a bunch of other advantages that we can unpack for you.
And there's certainly a variety of different ways to invest in REITs, of course. There's a lot of ETF products out there that offer broad exposure to listed REITs. Do you see any drawbacks in those types of products?
Yeah, firstly, it's a much more diversified space than the private market. But in terms of ETFs, I've got some stuff on here that if you look at the last 25 years and look at the differential annually between the best performing REIT quartile and the worst performing REIT quartile, the average annual performance difference between best and worst was 49%. So if there's ever a sector that seemed to warrant a more active long-short approach, the REIT sector would be amongst it. So if you're buying an ETF, you're simply getting it is very diversified, but you're not really positioned to take advantage of the different performance. What's happening in an apartment building in Victoria is different than what's happening in a hotel in Miami or an industrial building in Los Angeles. And those very different factors, and an ETF just is a very passive, diversified vehicle, doesn't reflect the different supply and demand fundamentals, the different macroeconomic conditions, the different political environment, the different capital expenditures that are required amongst different asset classes. And so it's a sector that clearly warrants a more active approach. And there's some data that recently came out that talks about passive versus active. And if you can see this matrix in the bottom left-hand side of this chart, the three blue dots are REITs. They're in the top right quadrant where active investing adds alpha, adds differentiated performance. One could argue that large cap, mid cap, small cap stocks, you might be well served in an ETF or a mutual fund because there doesn't seem to be a lot of alpha that is able to generate it. So it's an asset class that it benefits from active investing, and you don't get that through an ETF.
That's interesting. So, what is your strategy then within this asset class to provide this active management?
So what we do at Vision is, I mentioned briefly, we are a long short fund, so our strategy is not reliant on being bulls for real estate. We seek to outperform irrespective of real estate supply and demand fundamentals, which we call our blood, or valuations. We seek where relevant and appropriate to be active, value add, strategic investors. We don't seek to be hostile. It takes you 30 years to build relationships. You can damage them in one day. But if we can marry our real estate industry experience with our capital market expertise to add value to the underlying investments, we seek to do that. So the Vision funds have benefited from 22 takeovers in our portfolio holdings in the last 17 years at an average premium of 28% to where the stock was trading at the day before the announcement of that takeover. We focus primarily in North America because of what I mentioned at the outset. We want to be hands-on. It's a mistake to think we're going to be any good at that in Brussels or Beijing. We want to tour the real estate. And as I said, our mantra is seeking to buy real estate cheaper in the stock market than the property market. The advantages of what we do relative to what I used to do, or those that buy real estate directly through bricks and mortar, are by definition, you can't buy real estate cheaper in the property market than the property market. Why do we need to be the 17th entity to compete against a pension fund, a REIT, an entrepreneur with too much money in his or her jeans to buy property in an auction hosted by CBRE or Colliers, when we can buy real estate at 80, 70, 60 cents on the dollar in the stock market, have professional management, have corporate governance, have transparency, get geographic diversification, get property type diversification, get access to highest quality properties that may not be available at all in the property market. Even if they are, an institution or a family office might have to allocate too much capital to buy that one-off property. As I mentioned, nobody calls us in the middle of the night to fix the heater, and we have liquidity. And what liquidity is or should always be a paramount consideration. It's years like, March 2020 or, 2022, or when Brexit came to the forefront, where liquidity, or frankly, July, August 2025, where liquidity takes on a different dimension. I mean, in Brexit, it was multi-billion-dollar property funds, Standard Life Assurance, Aviva Assurance, and they promised their investors liquidity monthly. And then Brexit came along and they put up gates. And they said, what do you mean, gates? I just read the offering memorandum and it said I could redeem monthly. And they said, don't you know we own office buildings and shopping malls in London, England? And as you, John, know more better than most, anytime you have a mismatch between the underlying liquidity of what you're promising your investors and the liquidity of the underlying investment, those frankly are accidents waiting to happen. And we've got a lot of accidents happening right now globally. And it wasn't just what you read in the Wall Street Journal last year about Blackstone's B-REIT. It's what you read 1 month ago about Starwood's private REIT. It's KKR, it's Schroders. In Canada, it's well known. I'm not picking on anybody, but it's Romspen and Hazelview and Ninepoint and Kingset. They've gated their investors because they don't have the liquidity in what they're doing relative to what they promised their investors. And of course, the other big advantage we touched on a couple of times is the ability to short and not be a bull for real estate. And if markets are deteriorating or valuations are too high, we can take advantage of that by being short.
Yeah, you make it a very compelling case for doing this publicly versus private. Can you talk about the long-short strategy a little bit? Because a lot of investors may not understand exactly what that means or the mechanics of how that would work.
Sure. You'll hear an adage buy low, sell high. So if you think a stock price is going up, you try to buy it low, sell high, you buy it at $10. If it goes to $15, you buy it at 10, you sell it at 15, you made $5 profit. Being short is the opposite. You look to sell something you think is overvalued at $15. And if it goes down to $10, you can make the same $5 profit by the decline in value. Of course, if it goes up, you're going to lose money. So we use our short positions not to speculate. We use our short positions to reduce risk. And so the absolute returns of Vision pretty solid. You can see them here, about a 10% CAGR over 17 years. So they look favorable to Canadian REITs, US REITs, the broad stock market, property market indices, global Canadian hedge funds. But in our view, the most important slide in our investor deck is related to the question you asked. We don't seek to be the best performing fund in North America. We would like to be the very best risk-adjusted performing fund, and part of the way we achieve that is not just by buying at a discount, it's by being able to be short, and we use our short positions typically in a long-short paired trade, where we buy one security that we think it might be one office REIT that we think is undervalued, and we might short another one that is overvalued, or we might be long data centers and we might be short office buildings. And when you look at the attribution of performance, you must consider the pair. How did that pair perform? So, for example, we had one trade on 3 times, it was 10 years ago, in 18 months. You may be familiar with these names. We're long a REIT called H&R REIT. It's over a decade ago. And we were short a REIT, which is now a choice REIT called CREIT. At one time, they both went up in price. And we made money because the long went up more than the short went up. One time, they both went down in price. And we made money because the long went down less than the short went down. One time was a perfect world. The long went up, the short went down. We made money on both sides. Now, we could have lost money if relatively the long went down and the short went up. I'm not sure that's happened in 17 years. And so we don't use shorts to speculate. We use shorts to reduce risk and take advantage of markets when the fundamentals are weak or valuations are too high. And you see that play out in some of the risk metrics on the slide. I don't know if this stuff means much to your audience, but a real simple metric in the middle of the page, I'll take a moment to explain, is up market, down market capture ratios. If you look at all of the months in our 17 years track record, when the stock market was up, in months when the stock market was down, how did we do on average in up months? And how did we do on average in down months? Up market ratio is pretty good, 58%. First, I should qualify it. We don't use any leverage. We don't use borrowed money. We don't buy stocks on margin. So we never have full exposure on the long side. So 58%, not bad. But our down market ratio is 16%, so 3.6 times up market to down market ratio. So if the market's up 10%, on average vision is up 5.8%. If the market's down 10%, on average vision has been down 1.6%. And that's how we've delivered these compelling risk-adjusted returns. It's not by being up 25% in 2021. It's protecting capital in down markets. And if you think about our space, 5 of the last 11 years, 2013, 15, 18, 20, and 2024, REIT indices were negative, or the broad market was negative, or both, and we generated positive returns. So frankly, our advisors such as you spend a lot of time in risk management, our pension fund consultants. We look at a range of risk metrics. I translate it to one thing: don't lose money. If you don't lose capital, you'll probably do pretty well over the longer term. Most of our investors are not in the get wealthy business. They're in the stay wealthy business, and risk is important to all of us. I'm the largest single investor in the fund. I got to go see my wife every day at 7 o'clock.
It's extremely important to note, right? Like, most investors in Canada are focused on, like, almost singularly focused on preservation of capital. And so win by not losing is a major thing that we talk about. Let's shift gears out of the logistics and into what's going on broader. The macro outlook, given global uncertainties, a lot of people are very just anxious with all the change that's going on right now because they don't understand what tariffs are. They don't understand what kind of recession risk we might have. How do you see North American REITs positioned today? Are there tailwinds or headwinds? Like, what do you see out there that concerns you?
So let's unpack this, spend some time on it. It's a very loaded question, and there's, I think, a number of important factors that are important for folks to understand. So firstly, there was an adage, don't fight the Fed. That's evolved under the Trump administration to don't fight the Treasury. And we'll see how effective this is long term, but there's clearly some pressures on interest rates staying higher for longer, and Trump administration is really committed to keeping a cap on long-term rates. But what's really critical to understand is, while interest rates are important, they're always exceeded in importance by supply and demand. And we're going to unpack that a bit, and what's clearly happening right now is supply is falling off a cliff because of inflation over the prior 3 years. Construction costs are up, development charges, now we have tariffs adding to the equation, and that bodes pretty well for the sector, private and public markets over the next few years. Cash flow is clearly key. Let's talk about that, because we're seeing above average cash flow in the sector for the next few years. And we see that dispersion that we touched on a few minutes ago, the difference between favored and unfavored asset classes really being important to answer your question. So, I mentioned those myths, location being a myth. Another myth is how critical interest rates are to REIT pricing. And the chief economist for one of the leading banks, our chief strategist, was on CNBC last July, and he presented a study in this regard. This is reflected in the top right chart. He showed that there's a de minimis correlation between the yield on the 10 US bond and REIT prices. Not a surprise to us. That's our strategy. Supply and demand trumps interest rates. That's interesting. What he also showed is that REITs have performed their best historically when the yield on the 10 US bond was between 4% and 5%. Frankly, we would have predicted a little bit lower. But it makes sense for the same reason: supply and demand. If the yield on the 10 US bond is between 4% and 5%, unless it's a credit crisis, which is brutal for real estate, it's typically because the US economy is strong. If the US economy is strong, employment growth is strong. And if you got a job, you can buy a house or rent an apartment, or you're working in an office, or you're working in a factory, you're traveling, staying in a hotel, you're shopping in the mall. And he also showed that REITs have performed the best when the yield on the 10 US bond is either up or down 50 basis points. It's not whether rates are going up or down, it's stability. It's the narrow range. In real estate investors, REIT investors look for more stable interest rate environments to help them underwrite and make those decisions. So that's a key factor. And what's happened? Last 2 years, we've been in that range, that fairly narrow range, 4 to 5%. And volatility in rates have come way down. Those historically have been great times for REITs. Supply, I mentioned, way down. The factor of increasing construction financings, inflation, supply is way down. And you can unpack this by sector. You can compare it to the 12-month peak. You can compare it to the pre-recession high, but it's very difficult to make the economics of new development work. And that bodes really well because this demand has been sustained. Supply, new starts, is way down. Cash flow, always key. And projections are that cash flows in the REIT sector over the next couple of years through 2029 are forecast to be well above the historical growth rates, which have been 4.5%. But what you're seeing is bifurcation. Not all cash flow is the same depending on the property type. And non-core real estate is generating higher cash flow growth than core. What does that mean? If you're in the private market, it's dominated by core real estate. The bottom right pie chart here: office, retail, industrial, in apartments. That dominates private real estate. The other category is less than 10%. But in the REIT index, the other category is over 50%. And that's what's generating the highest cash flow growth. I mean, some of the sectors weren't even in the REIT index 10 years ago. Towers, single-family rental residential, data centers, self-storage. These are the sectors, these non-core sectors that are generating the highest growth. And in order to access them, you typically need to be in the REIT sector because they're dominated in that sector. To your question, there will be distress in certain pockets of commercial real estate. We've seen Blackstone, Brookfield hand back the keys to lenders in LA, in Washington office buildings. There will be no distress in REITs because of balance sheets. If you're a private equity fund, family office, you're typically using 60 to 70% leverage, borrowed money. Private equity, average family office, averages 65%. Blackstone just used 70% leverage to buy a U.S. REIT. The U.S. REIT sector today is 32.5% loan to value, 4.1 times interest coverage ratios, 91% fixed rate debt with a weighted average term of 6 years. REIT balance sheets are the best they've ever been. These management teams remember 2008 and the Great Recession. And the other huge advantage REITs have is if you're any other owner of real estate, a pension fund, a family office, a private equity fund, and you want to put debt on your real estate, you're getting a mortgage. 85% of the U.S. REIT sector is investment grade rated, and they use unsecured bonds, not mortgages, to finance their assets. And the cost of unsecured debt has recently been as much as 150 basis points cheaper than secured mortgage debt. This is a big advantage, 150 basis points in your cost of debt. So there's been distress in the property market. REITs have balance sheets and access to capital and cheap capital, and allows them to play offense in this kind of environment, which they are doing. Valuations. Historically, REITs have traded at a 0.6 times earnings or cash flow multiple to the S&P 500. Recently, they traded at 3.8 times multiple discount. Again, not everything's created equal, but that's on average. And dispersion. This is data from BlackRock. BlackRock projects over the next 5 years, listed REITs are expected to outperform U.S. large cap equities and U.S. core direct property by 130 beeps and 520 beeps respectively annually. And critical to our strategy is you see the dispersion, the difference between the green dot and the red dot, between the best performing quartile in each of these asset classes and the worst performing quartile in each of these asset classes. And the dispersion in the REIT sector is second highest only to U.S. non-real estate private equity. And so this bodes pretty well for the sector over the next few years, and in particular for a long short strategy where you can take advantage of that dispersion. And because of that disconnect on the critical difference between real estate and any other asset class is the size of the private market for real estate dwarfs the size of the public market. Public markets are big, 2 trillion, but private markets way bigger. And yet there is an arbitrage between the two. We say we'd rather not compete with Blackstone. We'd rather sell to Blackstone. You know, Blackstone's figured it out. They bought 53 REITs since they launched the real estate group. And so because of this disconnect between public market values and private market values, we've seen activism increase. We've seen a reversion of funds flow to the sector, and we've seen M&A activity. So you're minding your own business at the end of May. Government of Singapore pension plan shows up in Canada, bids and buys to rent REIT apartments in Ontario and Quebec at a 35% premium to what's trading in the stock market. And so this is a key differential when you have these kinds of disconnects and dispersion that is unique to the real estate sector, that arbitrage opportunity.
So you're saying pretty strong balance sheet, really strong balance sheets in REITs, appropriate valuations right now. There's probably investors trying to get out of private real estate investments but can't. It's an interesting outlook for, also on top of that, we've had several years in a row of pretty rough returns historically in REITs, right? Just the negativity around rising interest rates pulled money out of the space. There's a ton of great Canadian names that have just gotten beat up. So it would be helpful to understand how you're positioned today. Like, what are you long, what are you short, and give us some color as to why in some of these spaces. Some of it might be obvious, but you know, it for the average investor could be very interesting.
Sure. So we had a bit of an edge in Canada. The great orange man, Mr. Trump, started to pick on Canada well before so-called Liberation Day. So, you know, we came into the year and saying, look, we don't want any exposure to recession. We don't want any exposure to tariffs. So we're always pretty focused on the net long side. Today, it's really 4 or 5 themes. The first is grocery-anchored, necessity-based retail, where you have an anchor of a Loblaws, or in the United States, we like it both the United States and Canada, Publix, a Safeway, and no fashion. The non-anchor tenants, I mean, you can't get your nails done online. You can't get your dry cleaning done online. So it's not susceptible to e-commerce. It's become a darling asset class. Again, the Blackstones, Brookfields falling over each other to get exposure to this asset class. And I mentioned, I think in this discussion, that earlier this year, Blackstone bought Retail Opportunity Investment Corp on the New York Stock Exchange, grocery-anchored shopping centers on the West Coast US at a 34.5% premium to what's trading at in the stock market. Seniors housing. No recession risk, no tariff risk. There's a demographic, a secular play. The occupancy got crushed in the pandemic into the low 80s. I think about a year ago, for example, Chartwell, a name familiar to you and some of your clients, your occupancy was around 83%. They said by end of 2025, they're going to be 95%. Folks were skeptical. We were not. They're over 92% today. They may exceed 10%. What you got to watch in that sector is home sale prices because this stuff's expensive, $5,000, $6,000, $7,000 a month. And in order for seniors to make that commitment to move in, they're typically relying on the equity in their homes to sell their houses. And I'm not worried about, for example, Toronto. Home site prices could go down 15, 20%, but they've gone up so much over the last 10, 15 years, there's a lot of equity. But in other markets, the US, you got to watch home sale prices if that impinges on some of that occupancy. Data centers. This was a top attribution to our fund last year. Frankly, it's a sector we avoided for 10 years.
Right.
Because all the growth in data centers was external growth, external demand. The internal growth was actually negative. When the rack space for Google or Facebook and Amazon came up for renewal, they're actually paying less rent in the new lease than the old lease. That changed dramatically 3 years ago. Because anybody that knows anything about data centers understands the key gating factor is access to a lot of reliable, redundant power, energy. Well, municipalities started to figure it out 3 years ago. It was putting a strain on the community power grid. So you started to see restrictions and moratoriums on accessing power for new data centers. So Loudoun County, Virginia, which has 30% of the world's market share for data centers because of location next to the cable network under the Atlantic Ocean, put a moratorium on accessing power for new data centers. So for the last 3 years, when that rack space comes up for renewal, you're seeing 20 to 50% increases in rents. So you compound that with the growth in external demand, and then you think every morning you pick up the Wall Street Journal, the Financial Times, or the Globe and Mail, there's some pension fund or institution that says, we got to be in data centers, we got to be in AI. We say, how? How exactly are you going to do that? You have no global development capability. You have no global technology client relationships. And so the large existing public entities are very well positioned there. And finally, manufactured housing communities, probably the best real estate property class for 50 years. Institutions didn't get it for 30 years. Simply put, John, you go and you spend $200,000 to buy a prefabricated manufactured home. You put it on their land. They charge you land rent, $200 to $400 a month. You pay the property taxes. You pay the operating expenses. It's the most pure form of cash flow in the real estate space. So for example, Sun Communities, which we own today, between 2011 and 2021, over 10 years, it traded at an average 24% premium to the net asset value of the real estate because of these favorable fundamentals. We love the fundamentals, but that's not what we want to do at Vision. We don't want to buy it at premium. We want to buy it at discount. And last year, we've been accumulating Sun at a 10 to 15% discount to net asset value. This sector has never had, ever, 12 months of declining net operating income, including the Great Recession. Credit, who's not going to pay their $200 a month land rent at risk of losing the single biggest asset, their home? So we sleep well at night on behalf of our clients, knowing we have exposure to this sector. And then, how do we get through April? April was brutal, right? Second week in April, US REITs are down, 13, 14%. Yeah. We moved our office out of downtown Toronto a few years ago to Midtown, and it allows me to walk to work. And I'm walking to work and I'm thinking, wow, another day of this. I'm thinking, wait a minute. Eat your own cooking. You're the largest investor here, and look at where you own in grocery anchored retirement homes, data centers. And then I'm thinking, I wouldn't want to own a hotel in the United States right now with the reduction of international travel. Yeah, we're short hotels. Our biggest short weight today is in U.S. life science office space. There's three major pockets of life science office in the United States: Cambridge, Massachusetts, San Diego, and San Francisco. By far the biggest is Cambridge. There's 30% vacancy rate in Cambridge. Another 15% of the current inventory is under construction with new developments with limited tenants. There's pressure from the Trump administration on National Institute of Health funding. Some of the public biotechs are suffering from, capital pressures. And so this is amongst the biggest short weights we have today.
Office aside, like with
Yeah.
Cambridge, how did they get that so wrong? Like, how did the town of Cambridge get so overdeveloped and then continue to double down on it?
Well, it's a pocket. Why is it there? First of all, because of all the university academic institutions, the MITs and Harvards are there. So there's a concentration of expertise and scientific knowledge, pharmaceuticals in that area. That's why it's there. And, there was pandemic certainly added to it. There was a lot of funding focus from the pandemic. So a lot of these companies, got a new life. The biotech sector got a big lift, and they got money, and this funded a lot of interest in the sector. Vaccines, you'll recall that flurry to vaccine development. So there was a lot of money thrown at the life science sector, and that engendered demand for office. And there's a bit of a misnomer. I mean, coming in the pandemic when you had this work from home, one of the reasons we've been short for some time is he said, well, we're different than office because of the lab space. Half of the space is lab, and so people have to be in the office. They can't work from home and doing lab space. So we do diligence this two ways. One is we toured the real estate. And frankly, we went into this space and it was as empty as traditional office buildings. This is after people came back. And the reason is, you got to be in the office on a Monday afternoon or a Wednesday morning when you're doing your lab work. But the rest of the week, you can be at home writing up your lab. So we didn't find any difference in usage. And we looked at Place Your Eyes cell phone data, and we found no real difference between the presence in office, between life science, real estate, and traditional office space. So that, in our view, is a bit of a spin. The top 5 attributions to our fund in 2022 were all office short, 5 U.S. office REIT shorts. Now we're more balanced. We're long New York City office. We're constructive on Sunbelt U.S. office. We're short West Coast U.S. office, and we're short Canadian office. I mean, Toronto has the worst return to office statistics in North America. And industrial, which has done really well for the fund over a number of years. I think 2015 we coined the phrase industrial is the new retail in light of e-commerce activity and logistics demand. Again, now we've shifted away from the United States. We've shifted away from the big box, that major 35, 40 foot clear height, modern logistics space. That's how all the new supply. The so-called obsolete real estate, in middle of Vancouver or, Dufferin and Lawrence in Toronto, that's gold. It's close to the consumer. Nobody builds that stuff, and it's serving the last mile e-commerce distribution. And so we've got a sort of bifurcated approach in that regard as well.
Makes a lot of sense. I wonder, just for a moment before we kind of get to the last little bit of this, if you can pontificate on what would turn this office space Armageddon around in some of these towns. Like Toronto's a really interesting example. Pre-pandemic, you go there and downtown is absolutely bustling. And now you'd visit, and unless there's a Jays game going on, it's pretty quiet. Like, is it something that you could see turn this around?
Well, I don't want to get too political, but, the politicians in this town ruined the city. It's a very, again, I don't want to be political. Canada's not a socialist country. It is a socialist country. And the microcosm of your question is downtown Toronto. The construction, the closing of streets for no seeming reason, it's gridlock. It's very difficult to, do we need a bike lane in every street? They're not used. It's just political. It's not environmental. It's done under the guise of environmentalism, where it's anti-environmental, frankly, because it's creating gridlock and pollution. And so it's much bigger than the real estate market per se is part of the solution to this situation. Dramatic political change is required to turn around some of these cities The development charges that are being extracted are make it punitive for new supply in sectors that are needed, such as affordable apartments. You've got rent control legislation. It's politically favorable, but it hurts those that it's trying to help by restricting supply. You can't solve a demand problem by restricting supply. So it's much bigger picture than the real estate side, for sure. In the office market, it's going to take a while. I mean, we see a 15% long-term reduction in demand. Certainly, there was an article in the Globe and Mail, was it today or yesterday? I think it was yesterday, that the return to work mandates from some of the banks is certainly going to be helpful. They assert that there's a shortage. There's a shortage of the very best AAA space, that's for sure. But this so-called, former Class A buildings in Toronto, TD Bank Centre, Commerce Court, to First Canadian Place, lots of vacancy. And so some of that stuff needs to get filled up for sure to help turn that around. So it's a very complex problem. The transit system has got crime, it's got, deficiencies. We have billions of dollars being spent on a new rapid transit line on Eglinton Avenue in Toronto. It doesn't work. It's been ready to go for 2 years and it doesn't work. So there's all kinds of problems that it's not an easy thing to solve.
Yeah, I think that sentiment is felt clear across North America, not just in Toronto, that it probably needs to get a little bit worse before it can get better, right? Because you need the political pendulum to come back the other way, and it doesn't seem like we're there yet. Anyway, we could talk about that for hours, I'm sure, but it probably would require a beer. The last question I want to position to you, a lot of investors have an enormous amount of their personal wealth locked up in their home, and they'll talk about, well, if all my wealth is disproportionately in real estate already in this one home, should I invest in other real estate? What's the reason that I would further put money in my portfolio into real estate? And that's probably the most common kind of pushback, right?
Sure. I mean, maybe I can answer the question by talking about one category investor. We have, probably 50 iconic real estate families that have known one thing their entire lives for multi-generations: direct property investments, bricks and mortar, and cash. They don't like the stock market. They don't understand the stock market. They don't trust the stock market. What are these iconic families doing investing in a real estate fund? If you ask them, because we're curious, you get one or two of four different replies typically that help answer your question and really address our strategy. Number one, you can be the best, office family in Toronto. You've got the tenant relationships, the brokerage relationships, the political relationships, the banking relationships. You wake up one morning, your son or your daughter wakes up, says, "Dad, we should be in Vancouver office." No, Dad, we should be in Chicago apartments. Dad, we should be in the single family rental residential business in California. We should be in hotels in New York City. Well, you know nothing about these markets. You know nothing about these property types. And I don't know about a generation, but it's going to take the family 5 years or so to get enough comfort to make some incremental investment. So the first reason is, this is an asset class these families like, it's property, but it gives diversification to the family by property type and geographic region. Secondly, these guys are smart. When they look at our strategy, they look at our holdings, they look at our track record. They understand they can't buy real estate cheaper in the property market than the property market, and we can. And these were originally a lot of first-generation immigrant families. They like buying anything at a discount, but real estate at a discount is virtuous. Number three, these guys are smart. And if the fundamentals are negative or valuations are too high, they like to use their expertise, their knowledge to make money in the declining market by being able to be short And the fourth is liquidity. To have diversification to their family by property type and geographic region, to have liquidity is not something they're going to have in their house or their other real estate. And we love them because they're strategic. No disrespect to, we're the exclusive REIT alternative fund for JP Morgan. No disrespect to JP Morgan or some of our institutional investors. But we love these guys because if we want to know what's going on in our property type or geographic region, we know who to call. They're friendly, they're aligned and constructive. So this is pretty relevant to your question, is that yes, it's property, but the factors that drive the investment are quite different. And frankly, I don't think people should buy a house as an investment decision. It's a lifestyle. You shouldn't rely on a capital gain to make a decision to buy a home. It's a lifestyle decision. It's, can I afford this? And this is the reason. Yeah, it's long-term store of value. It's estate planning over the long term. But you shouldn't be looking at your personal residence as a key investment in our view.
That's awesome. Jeff, I appreciate you taking the time today to sit down and talk to me about this. You make a compelling case for not just investment in real estate, but a strategic, active look at what you're doing with both the long and short sides of it. Thank you so much again. And look forward to talking to you next time in Toronto, and we can get into the political side of it, maybe over a beer.
Pleasure to chat with you, and if you or your clients have any additional questions that we can be helpful to unpack, please don't hesitate to reach out.
Appreciate it.
All right, take care.
The content of this podcast, including facts, views, opinions, recommendations, description of or references to products or securities, is not to be used or construed as investment advice, as an offer to sell, or to the solicitation of an offer to buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Although we endeavor to ensure its accuracy and completeness, we assume no responsibility for any reliance upon it. Raymond James advisors are not tax advisors, and we recommend clients seek independent advice from a professional advisor on tax-related matters. The views are those of John Helm and not necessarily those of Raymond James Limited. Securities products and services are offered through Raymond James Limited, a member of the Canadian Investor Protection Fund. Insurance products and services are offered through Raymond James Financial Planning Limited. Raymond James USA advisors may only conduct business with the residents of the states or jurisdictions where they are found to be registered, and Raymond James USA is a member of FINRA SIPC.